Welcome to TMS Insights as we end October. Jeremy Hook and Ben Clark here to bring you some of the updates and the news of what's been going on. And certainly there has been a lot going on in the markets. October has been actually quite a positive month to date, up about 2.5%, but September, Ben, was tough, down 6% in the market, and a lot of things did change over the last couple of months.
Certainly, I think we've been saying for a while now it's just been remarkably calm, the markets for most of the calendar year, and it was inevitable at some stage we were going to see a correction. And I think as the calmness took a lot longer than you would normally expect, and therefore the correction was that bit more severe than you would normally sort of see.
Yeah, and it really starts to understand how it all works. I think people might remember we were relatively calm about the whole exercise a month ago when we spoke, and we saw it really from a bond and foreign exchange market impact, and we definitely here in the Australian equity market we're at the bottom end of all those ramifications.
Definitely, because I think what happened was international investors very rapidly arrived to a view that US rates were going to start to rise next year. Stimulus was coming off the sort of emergency settings we've had for 6 years now, and what you saw then was huge swathes of money move around the world to sort of back that view. And one victim of that, of course, was our local share market as our currency fell heavily. And in tandem with that, the iron ore price was falling very heavily, which led to us underperforming the rest of the world. And money was repatriated back into America. But that really bottomed out when we saw that flash crash in the US bond markets, when a lot of shorts were covered and yields sort of bottomed out. And since then, we've seen a pretty encouraging rebound. And
there was a day that the Dow Jones was down 420 points during the session and closed down at 170. And there was around at the same time we saw iron ore prices bottom. We saw that bond market correction almost ending, and that was the signal almost that you saw the turnaround begin. And the markets have more or less improved from that point. All markets altogether. So sitting here at the moment, our dollar's sort of settled and gone back up a bit. Iron oil found a base and have moved up a little bit. In the Australian market, which I mean, the bottom line for all of us and when we're investing in the Australian market is that we saw a lot of quality companies fall, and only for these macro kinds of reasons. And they're often when we see best buying opportunities, when it's just a generic sort of sell-off. So that turned out to be the case. And we still see that in the market at the moment, a lot of stocks are still well down from where they were. The opportunities exist in the better quality ones because all stocks being sold off, you do get the opportunity to move up the tree, so to speak.
Absolutely. And we're coming into the AGM season at the moment. We've had some already commence, and this will be a time over the next few weeks where we do get some trading updates from businesses. So that's definitely worth paying attention to. We're nearly into November now, so 5 months of the financial year has passed, and we should get a better sort of read on how different businesses are performing and where some opportunities might be with that combination of the weakness in prices.
Some of them will be good and some of them maybe not so good, and the early ones show exactly that sort of pattern. And all that could point to the year turning out just like actually a lot of years do, where you see the jitters of September, October, and opportunities present over those summer months for better markets to appear.
Definitely, the Christmas rally.
Now, as the year's coming to an end, we've got a large IPO about to hit the market. That's Medibank Private, and Ben, this is one of real interest to us.
Absolutely. It's not a private equity player selling to the market, which is what we've been like to see. It's a government-run business that we believe will be run much more efficiently in private hands in the future. So some good gains on the cost side of the business. It's in a sector where people were virtually pushed into by the government due to the tax treatment of health insurance, and of course, people very rarely rotate between providers, and therefore customers become very sticky customers generally for life.
No, that's good, and the business is the dominant player in the private health insurance business. 29% market share, so it's got a leading position. The metrics are interesting, no debt, so they'll be able to gear the balance sheet and create better returns. The returns already are good at 18% return on equity, certainly appealing. And on the pricing level, when we come to buy it, the pricing will be done by an institutional tender process, but the bid range is $1.55 to $2, which means a PE multiple of around 15 to 19 times. which is pretty reasonable, I think. I'm not feeling that's too expensive.
And
a yield of about 4%.
Probably slightly on the higher side, but we probably see, and we should say now that we're not looking for some sort of stag profit on day one. We're looking to invest in the business because we think the gains that will flow through from this being in private hands will take a year, 2, 3 years to really come through.
Yes.
And also, some potential action on the capital side, the capital management side of the business.
Yes.
We saw NIB floated with a zero debt on its balance sheet, and it's since paid out a huge amount of capital returns to its shareholders, whilst getting that gearing up to probably a more suitable level of about 30% debt to equity.
Yes.
So, that potentially could happen with this business as well.
Excellent. And the dates that matter here, we've put in for a broker firm offer, so we're going to find out about that at the end of this week, and we'll be able to advise next week. That's the first week of November. The other ways are through the pre-registration process, and that'll entitle to a greater amount of shares than the general public will get. And then, of course, we may have to buy some on the market when they come if we don't get enough of what we wanted in that way or form.
And you would have to say that the eggs are lining up in terms of a healthy aftermarket. We've heard that our broker bids will be very heavily scaled back. There's a lot of demand. One of the joint lead managers closed its books a week early because it was swamped with demand from brokers. Institutions are already crying foul, as apparently brokers are being paid double the commissions to sell shares to overseas funds and potentially leave local funds who are forced to own this stock to have to buy shares on market after, because they won't get their full entitlements. So the government seems to be handling this quite well in terms of making sure that it's not a failure on day one. You've got to remember, I think the government will be keen to leave something on the table for effectively its voters and to make sure that they get a good experience out of this float.
Yes, absolutely. So do contact us, any questions around Medibank Private or the market generally, and we'll be back in another month's time to bring you more updates from TMS Capital.